one. Fantastic. Excellent. So chapter one of the best things we're going to talk about is the PCAOB, as you can see right here, Public Company Accounting Oversight Board. So it's basically, the former chairman said, our system of capital formation relies upon the confidence of millions of savers to invest in companies. And the auditor's opinion is critical to that trust. And we kind of lost that with Enron. So we're going to see how it goes now. All right, so this is everything you're hopefully going to learn in this chapter, but we'll go step by step and we'll kind of get you through it. So first things first is business risk and information risk. So business risk is that you as a business are not going to meet the objectives that you set out. So today's businesses, they have a ton of information. There's a lot of demand by remote users. There's demand for more timely information. There's also demand for visualizations, and just has a bunch of reaching consequences, right? So information is getting more complex, and the auditor needs to understand the client's information and kind of get it and make sure that we can issue an opinion. So we have information risk, right? So that's the probability that the information that's being circulated by the company is either false or misleading. And then users always want, and users of the financial statements demand, that an independent third party kind of assess that information, and that's where the auditor comes in. That's what we do. We assess management's assertions, which we'll talk about. So here's just a little bit about audit quality, and audit quality has decreased a bit, but hopefully now with the PCAOB, which was enacted by the SEC, has gotten a little bit better. But basically there's reports that come out every kind of year about audit quality. And then there is the Center for Audit Quality, CAQ, that's also important. So here we have a definition of auditing, and it is the systematic process of objectively obtaining and evaluating evidence, and make a note that evidence needs to be sufficient and appropriate. Let's do that. So evidence has to be sufficient and appropriate. Okay, regarding assertions, which is management's assertions. Oh, see, now I lose my mouse when I do this. Bloody hell. Wait. Yeah, see, it doesn't let me. Oh no. Hang on. I think, it's not letting me do this. 1 second. Anyway, all right. We'll see if I can figure it out. Oh, wait, see, bloody hell. Hold on. Perfect. There we go. Let me see. Clear all drawings. Okay, I think I got it now. I was losing it. So management. So auditing is a systematic process of objectively obtaining and evaluating evidence that we said is sufficient and appropriate for the decision that we're making, which is the audit opinion, and regarding management's assertions. So right here where it says assertions, those are management's assertions about economic actions and events to ascertain the degree of correspondence between the assertions and establish criteria and communicating the results to interested users. And so here, the established criteria is GAAP, and we communicate those results through our audit report. And I showed you last time on the SEC's webpage, the audit opinion, right? And interested users, that's anybody that relies on the financial reports, which is creditors, investors, bankers, financial institutions. So basically what we're saying is that we as auditors, we provide some level of assurance, and we do that by obtaining evidence that's sufficient and appropriate. And we actually we provide assurance to management's assertions, because management is the one that has those assertions, and we're just testing that. And we make sure that we follow GAAS and GAAP, right? So GAAS is GAAS, generally accepted auditing standards, right? And then GAAP is generally accepted auditing principles. So GAAS, GAAS, is what we kind of do. And then we have ASs that I showed you with the PCAOB auditing standards. Okay, So here is the overview of what we're pretty much doing, right? So we have our financial statements here, as you can see, and you see we start with the footnotes, right? So we want to make sure that that's also included. We have the balance sheet, the income statement, the statement of cash flows, and here we have management assertions, right? And that's what we're testing. And here we obtain and evaluate evidence, right? And so our independent third party is us, the independent auditor, and we have GAAP and IFRS. International Financial Reporting Standards. And basically, this is what we're trying to do. We get the client's business, we try to understand it, we try to get observations of physical assets, we, ask managers questions, we get confirmations from third parties like the legal team and cash, and then we inspect these documents to get us this evidence, and then we issue out the audit report. Okay? So this is what we're doing. We are doing an attestation engagement, right? Which is basically we're assessing and report on subject matter or an assertion about a subject matter that is the responsibility of another party. So in that case, it's management, right? And so some financial engagements that we do, or we could either have financial forecasts, we examine the MD&A. So this is MD&A. Management discussion and analysis. And we saw that in the SEC report, right? And then pro forma financial information is like budgetary information. But then we might also do some non-financial attestation, which is maybe evaluate the effectiveness of internal controls. Maybe if there's a regulation, like environmental regulations like EPA, we might have to do that. Sustainability reporting is becoming more and more important. And so that's another area that we as auditors are looking into. Okay, so now we have assurance services, and these are independent, professional services that improve the quality of the information. So XBRL is existential business reporting language, and we saw that in the SEC. We might also talk about customer surveys, internal auditing, fraud, my favorite, and illegal acts, like prevention and deterrence. Cyber risk assessment is also becoming very big. Right here under cyber risk, you may want to note that it's the AICPA has SOC 1 and 2 now. So AICPA has the SOC, statements of concepts for 1 and 2 to kind of deal with cybersecurity and cyber risk. So we'll just make a note of that. And my favorite, Sarbanes-Oxley, SOX is how we call this. So what this established is basically in 2002 when the whole Enron scandal happened, and yes, I was at Arthur Andersen at the time, and I was an external auditor at that time. And so basically one of the things that it tells us is that right here, the management team is responsible for the financial reporting process and the financial statements. Then in section 302 of Sarbanes-Oxley, it says that the key company officials must certify the financial statements. So that means the CEO and the CFO sign a statement saying, hey, they read the financial statements. They are not aware of any false or misleading statements or any omitted disclosures, which was added, and then that they believe the financial statements present an accurate picture of the company's financial condition. So basically what Sarbanes-Oxley did is, and this you want to remember, that the CEO and the CFO, both of them have to say that, yes, there's nothing false or misleading. They have to sign off on the financial statements and that there's no omitted discussions. So that's very important. Oops, we are going backwards. So that's going to be
I have a question.
Oh, yeah, what's up? Yeah, if you have a question.
What was the auditing process and standards like before the Enron scandal hit?
They were not the PCAOB, but it was mostly just GAS, generally accepted auditing standards, right? And so then now with Sarbanes-Oxley that came into play, then the SEC took a bigger position, created the PCAOB and said, now you have these auditing standards. But prior to that, it was mostly just GAS and the AICPA, which we still use. So the AICPA still gives us our practical guidelines as well and a lot of audit updates. Good question. Excellent. Any other questions? This is fantastic. Always interrupt me. That's wonderful. Thank you. Yeah, so it used to be just GAS. Now we have the PCAOB, then we have SEC, then we have AICPA, and then we have Sarbanes-Oxley, and then we'll go into a bunch of others as we go along as well. There's a lot of regulation now, and still audit quality is in trouble. And then the Center for Audit Quality, the CAQ, is also provides us some guidelines as well, now that I think about it. Yep, good question. Okay, so this is just basically describing the relationship, and you see how small the audit engagement is? So we provide assurance engagements or attestation engagements, but auditing is more difficult. So because we have to do more work in an audit. So that's the key takeaway there. So this is important. You need to remember the 5 management assertions per the PCAOB. So existence or occurrence, completeness, valuation or allocation, rights and obligations, and presentation and disclosure. Very important. So make sure you know that. So this is per the PCAOB. This is management's assertions that if an asset is there or a liability is there, it exists. So typically here, what we would do with like fixed assets, we would actually go out and observe that. Completeness means that all balances and transactions have been recorded. So everything is like every single transaction you have. We run completeness or reasonableness checks, especially for revenue, because we want to make sure it's recorded in the right period, right? So for example, if we have a calendar year and the item shipped on January 1st, that's not recorded in revenue in December. It should be in January, right? And so we check for that. So we usually check the last 5 or the first 5 invoices to make sure everything is recorded properly. Now, valuation or allocation here is where you are making sure that you're adhering to GAAP. So investments are recorded. If they're trading securities, they're recorded at market value. If they're held to maturity, they're recorded at cost. And so that's pretty much what valuations and allocations are. Rights and obligations, if there's a legal claim, we do issue a confirmation to all the legal teams. And we do that at the very last step of the audit. And that's what we're doing there is making sure that all of the legal claims are included in the footnote disclosures, or we have accruals. Also, if you have if you have a capital asset or a capital lease, we want to make sure that's recorded properly. And presentation and disclosure is making sure all of the footnotes tie to our financial statements and all of the information that we need to have in there is in there. Okay, now we have management's financial statement assertions, right? And so very similar, completeness and cutoff kind of go hand, but it's about each transaction. And we add accuracy to that, and we add classification to that. Then we talk about assertions for the account balances. So here we had transactions and events, right? We want to make sure they occurred, they're complete, they're recorded in the right period, they're accurate, and we're properly classifying it in the correct account. Then we talk about account balances. They exist. So if there's an AR balance, we verify that. We usually send accounts receivable confirmations. Rights and obligations, we talked about the legal claims. Completeness, we want to make sure that everything is according to GAAP. And then accuracy and valuation, everything is reported as it should. So if it's market value, historical cost, inventory valuation, LIFO, FIFO, you name it, that's how we look at it. Then we have presentations and disclosures. Everything that occurred, we have a right and obligation to, so we're adding it in the footnote disclosures, making sure all of them are there, making sure that the classification and it's understandable to people using the financial statements, and making sure they're accurate and valid. So all of those 3, that is the probably one of the most heavily tested. So these 3 areas right here, transactions and events, account balances, and presentation and disclosures, one of the most 3 heavily tested areas on the CPA exam. Okay, so if you want to study for the CPA exam, this is what we're going to study. Okay, perfect. So now it just tells you each assertion and what it's basically going after, right? So, does the assets exist? Completeness, everything recorded, including the footnote. So this is just like a little table that you can kind of see where we're at and where all of the assertions come in. And then this is my favorite, because this is basically how the assertions make sense, right? So here we have cash, does it exist, right? So that would be, we would send a cash confirmation. Here we have inventory, rights and obligations. Do we really own the inventory? We purchased it, right? So now it's in our warehouse, so we're going to check that. Valuation for investments, completeness, is accounts payable. Did we have all of the accruals that we need? And then remember I told you that the summary of significant accounting policies is always the first footnote. So we see that here as well. So that's all of our footnote disclosures that we need. And then here occurrence, where net sales, we test revenue extensively, because revenue is always a high risk area, right? Because what happens to revenue? Do companies over report or under report revenue, do you think? You can type it in the chat if you want. Under report. Typically, no, that's okay though. We'll learn because we over-report. That's okay. We're learning. And why? Because revenue, right? We want to make it better, right? So we want to say that we sold more money than we did. So that's why it's a high-risk area. Unless the only time we probably would under-report, but we usually do that with expenses. It's called taking a big bath. And so say, the company is going to miss earnings expectations, right? And so then they're going to miss it really bad. Then they're going to put every single expense they can in to miss it really bad. So then the next time when they report earnings, they'll look really good. So, and that's what we have to make sure that we are checking for as auditors. But thank you. Excellent. So now we have professional skepticism, and this is what we need to keep throughout the entire audit process, right? And what this is basically you as auditors have to have a questioning mindset, right? Any representation the management makes, we need to gather what's known as evidential matter, which is evidence that's sufficient and appropriate, right? We just can't ask management. We have to get some type of evidence, which is our work papers. So here, if there's some financial trend that needs investigation, documents are always checked for authenticity or possibly alterations. You ask questions, you get answers, then you verify. That's the whole audit process. But you have to be skeptical because there's a conflict of interest, right? Always exists between the auditor and the client, right? Management wants to say the company's great, and the auditor wants to say that they've done their work and it's fair and accurate. So we always have this back and forth. So we need to make sure that we keep that questioning mindset and just make sure that you follow the evidence. So let's see. So here what we're doing is we're just kind of seeing what issues and objectives we have. We consider alternatives. We gather and evaluate the evidence, make sure it's sufficient and appropriate. We reach an audit conclusion, which is we issue an opinion, either a clean opinion or unqualified opinion. And then we document this rationale throughout the entire audit via what's known as tick marks. So tick marks are how we kind of show our work on the audit work papers. And then, what's going on? So now we have what type of firms. So last time I think we talked about the big four auditing firms, which are public accounting, right? And we would do financial statement audits, assurance or attestation engagements, reviews, and compilations. So a compilation is basically you just take the general ledger for the client and you compile it to make financial statements. A review is you do the compilation, but now you do a little bit of more digging to make sure that it's correct. And then an audit, you have to check everything. And typically in an audit, we beat up the balance sheet. And then, so if our balance sheet is clean, we say our P&L or our income statement is clean, right? And so basically, if you think of revenue, you're either going to record revenue, and I think we went through some of these transactions, while we were doing our financial review. You're going to, debit accounts receivable or cash and credit revenue. So if we check cash and accounts receivable, then as we do the sales process, we'll check revenue to make sure it's good. And then we can do tax services and consulting and advisory services. And we're going to see that we can do auditing and tax for the same client, but we can't be their advisor as well. We can't be their consultant. It didn't used to be that way, but we'll go into that. So you typically see here you have like either a chair or a CEO, then you have managing partners right up here, and then you'll see you have assurance service, advisory services, and tax services. If we do, we can do these two for the same client, but we can't be their advisory or consultant as well. So that's where we get in. And then you'll see we have a partner, a manager, and then you have seniors and then staff. And so when you start as a staff accountant, then you go to senior, then you go to manager. And I think as a manager, as a partner, you can write in pen because you couldn't write in pen before until you go high up for that. And then as a partner is where you can sign the audit opinion as well. And as a partner and manager, you need to be a CPA in the public accounting firms. So I highly recommend getting that. And then you see here a bunch of revenues. They make a boatload of money. Woohoo! That's good. That means you can make money too in auditing and assurance services. So that's just kind of telling you which all of them are. And as you can see, it used to be E&Y was like number one, but they keep going back and forth now. So it's a little different. Now, here is where you need to make note that Sarbanes-Oxley now prohibits professional service firms from performing any client services for audit clients in which the auditor may find themselves making management decisions or auditing their own firm's work. So we can't do that. So specifically prohibited that if you're going to audit the client, you can't do bookkeeping. You can't do anything with their financial information systems or their accounting information systems. You can't do appraisal or valuation services or actuarial services. You sure as heck cannot be their internal audit department. You can't do anything management or HR related. You can't do any investment or broker deals. And obviously you can't do any legal and expert services that are not related to the audit. So basically, you can provide tax services with some restrictions. Oops, wait, go back. Let me move this here. With some restrictions and other non-prohibitive service to audit clients if the company's audit committee has approved them in advance. So typically what we can do the audit and we could do the tax. But other than that, we can't do anything else. Oops. I keep doing that, sorry. I don't know why, my mouse is going crazy. So this is important, so make a note of this, whatever slide 23, keep this close because you're gonna have some exam questions on this, and we'll go over some of them on Wednesday and Friday if we have time. So make sure that you can't, so basically if you do audit and tax, that's it, but you can't do other services, so you can't really do their bookkeeping, compilations, none of that. So make a note of that. Then we have internal auditing, governmental audits, the GAO, and then regulatory audits. Typically, as an external auditor, you work for a firm like Grant Thornton or BDO Seidman or one of the big four, and then you go out to the client site and audit. In internal auditing, you work for the company. Right? And then you work for Walmart and then you check the information before the auditor gets there. So as an internal auditor, the external auditors are going to use a lot of your schedules. They're known as lead schedules. And then the external auditors are going to give you what's known as a PBC. So provided by client list, like, hey, are you going to give me all this? And those are the lead schedules that you start to audit. And then as an internal auditor, there's a lot of compliance, right? Compliance with the rules and regulations, compliant with your debt covenants. And then there's also is the operation efficient and effective? Whereas an external auditor, he doesn't care. He just wants to make sure the numbers are right. We do provide some value added services as an external auditor telling you that, yeah, look, you've touched this paper 5 times in this process. Maybe if we streamline the process, you might save some money, but not so. And then regulatory audits are usually banks. So banks come in and they want their debt covenants to be, they want you to do a lot of work to make sure that your ratios are good. So that would be an example of a regulatory audit. And so here we go, get certified. I highly, highly recommend the CPA exam. That was the first certification I have. I have 4 certifications. They're all active. It keeps me, I think, young. I try to be, and abreast of the profession. It's a lot of money, but I think you'll make a ton of money. So this class here will get you to pass this auditing section. FAR is a lot of students find it the most difficult, reg, and then BEC. And so you have multiple choice questions. There are now task-based simulations. They're also looking for more higher order skills in critical thinking, and there's a writing component. So it's getting harder and harder every time, but at least, it'll be so worth it. I'm so glad I did my CPA right. So I did my bachelor's and my master's. So I went straight through. Took me 5 years, and then I sat for the CPA exam, passed, hallelujah. Then I started working, and then I started working at Arthur Andersen, and I really love my public accounting days. So I really have to say, not everybody likes public accounting, but it really propelled my career. So when I was done as an audit senior, I got double promoted twice in Arthur Andersen, and I was going to be manager, and then Enron hit. And so Andersen was no more. So then I became a controller. And then I did, I think, 4 or 5 different controllerships and finally became a CFO. And I loved my CFO job as well. And I was in that same company for 5 years. And so it really propelled, you learn a lot when you are in public accounting. So I highly recommend it. Definitely take the CPA exam. You see all of the areas that you have to do. Now there's 72 multiple choice questions and then 8 or 9 task-based simulations, and it covers all of these areas. So as you are preparing, but this class will prepare you hopefully for that. And then basically it tells you all of the requirements. You need 150 credits. And then here I have a CFF. and I have a CGMA, but these are all the other, like you could do a certified internal auditor. And then if you want to be a CMA, you can do that. We get 10 scholarships a year. So if you really want to, and that's free. So basically you could sit for the CMA exam free. I am the advisor for the Institute of Management Accountants, and we have a chapter that we kind of work with the SAA. But basically, if you want to sit for the CMA exam, you can absolutely do that, and you can absolutely, do that while you're still in school. And so it's really nice. So that's one area. So if you do want that, or you're thinking about it, then 1 year, let me know, and then we'll add you to the list. And I recommend doing it like when you're mostly getting out of school, or like you're gonna, if you want to do it in between, like a summer. But it's only 2 sections, as you can see, and then that's pretty much the certifications. And then instead of a CFE is also the ACFE, the Association of Certified Fraud Examiners, is what gives out this certification. And what I did is I did it through the AICPA. So I did a CFF, Certified in Financial Forensics. And that allowed me as the CFO to be an expert witness and be, and like then I would accuse my franchisees of not reporting their revenues, and then go take them to court and, get my money. So those are all the fun areas. So definitely there's plenty of certifications that you can get, and there's a lot of them, but the more you get, the more fun it is, I think. And also the more you have to do. So then the more CPEs that you have to do. And so here you see the Association of Certified Fraud Examiners, and then the IMA. And then this one is becoming Certified Information Systems Auditor. This one's becoming more and more prevalent, especially since we're doing a lot with data analytics, and we're doing a lot with like a lot of AIS systems, visualizations, and big data and blockchain. So this is becoming really important. And one aspect of the audit is that we are kind of, we have to look at the internal controls, but systems are becoming very important, right? And so we have a lot of data, and we have to manage that. So that is, you made it.